Did you miss your opportunity to save in 2025 taxes? We are already in 2026. 2025 is already closed. The year-end window is gone. So, did you miss your opportunity to save? If you didn't do tax planning before December 31st, are you just stuck with whatever you owe? My name is Noura and I help entrepreneurs stop overpaying in taxes. And if you know me, you know I always talk about planning ahead, making decisions before the year ends. But here's the good news. Even though 2025 is over, there are still strategic moves that can reduce your 2025 tax bill if you act before filing. And in this video, I'm going to walk you through exactly what we are talking about so you know whether this applies to you or not. A retirement contribution that can still lower your 2025 taxable income, depreciation on business assets you may already qualify to deduct, and the home office deduction if you worked from home in 2025. If you earned 1099 income, owned an LLC, run an S Corp, or had business income last year, stay with me. Because one of these could still change your final numbers. Let's break it down. SIP IRA, a contribution you can still make. Let's start with the first strategy, a retirement contribution that can still reduce your 2025 taxable income, even though we are already in 2026. I am talking about a SIP IRA account. If you had self-employment income in 2025, Schedule C income, an LLC, partnership income, or even an S Corp where you paid yourself wages, you may still be eligible. Here's why this matters. A SIP IRA can be opened and funded up until your tax filing deadline, including extension. This means you can still make a 2025 contribution in 2026 before filing your tax returns. Now let's talk numbers. If you are a sole proprietor or single member LLC filing Schedule C, you can generally contribute up to 20% of your net earning from self-employment, with a maximum cap of $70,000 for 2025. If you operate as an S Corp, the calculation is different. You can contribute up to 25% of your W-2 wages, not your business profits, and not your distributions. And in all cases, the total contribution cannot exceed the annual limits. And that contribution reduces your 2025 taxable income, lowers your federal tax liability, potentially lowers your state taxes, build retirement wealth at the same time. If 2025 was a strong income year for you, this can be one of the most powerful adjustments still available, but it must be calculated properly. Contribution limits depend on your net earning if you are a Schedule C, or on your W-2 wages if you are an S Corp. This isn't something you guess. You run the numbers, look at your income, evaluate cash flow, and decide what makes strategic sense before filing. Now let's talk about something I see missed all the time: depreciation. If you purchased equipment, computers, office furniture, business vehicles, you may qualify to deduct a portion or sometimes a significant portion of what cost in 2025. Depending on the asset and your income level, you may be able to accelerate deductions instead of spreading them over many years. Here's the key: depreciation is not automatic. If assets placed in service in 2025 are not properly reviewed and recorded, you could miss legit deductions. Specifically, if you bought a vehicle late in the year, upgraded your office, invested in scaling your operations, purchased large equipment before filing. Entrepreneurs usually remember their income very clearly, but they often forget capital purchases that could reduce that income, and those numbers matters. Now, let's talk about something especially relevant for entrepreneurs, the home office deduction. If you use part of your home regularly and exclusively for business in 2025, you may qualify. This applies whether you run your business full-time from home, operate a side business, do consulting or coaching. There are two methods. The simplified method, which is based on square footage, or the actual expense method, where you allocate a percentage of mortgage interest or rent, utilities, insurance, property taxes, repairs. The key requirement is exclusive and regular use. If you had a dedicated office space in 2025 and didn't calculate this deduction, you may be leaving saving unclaimed. You're leaving money on the table. This is one of the most underutilized deductions I see among entrepreneurs. So let's come back to the original question. Did you miss your opportunity to save? If December 31st passed without planning, yes, some strategies are gone, but not all of them. Before filing your 2025 tax return, ask yourself, did I evaluate AICPA IRA contributions? Did I review all business assets placed in service? Did I properly calculate my home office deduction? Even though 2025 is over, your ability to influence your 2025 tax bill may not be. Once you file, your flexibility decreases significantly. So don't rush to submit without reviewing these three areas first. If this was helpful, subscribe to this channel, share with another entrepreneur before they file. Now, share with me in the comments what strategy you will be using this year.